This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
So today we're at the MoneyPot stage at Money2020 recording episode 232 of Breaking Banks Europe, news from the FinTech Front. I have two great FinTech insiders with me. So I have Simon Taylor, head of content and strategy at Sardine, former founder of 11FS, and now author of FinTech Brain Food.
Thanks for having me.
Thanks for being here. I also have Rita Martins, who's the author of Web3 and Financial Services. Rita headed the FinTech partnerships at HSBC. Thank you for being here.
Thank you. Good to be here.
So if I missed any salient points about your background, please just jump in and add to what I said.
No, I'm not going to tell you where the bodies are buried, but...
Not today.
No, not today.
All right. So let's dive into the story that I think is one of the most top of mind, and that's the Synapse dispute, or the fact that after this U.S. banking as a service provider declared bankruptcy in April, that as of mid-May, their partners didn't have access to the tech. They're self-proclaimed the biggest banking as a service provider in the U.S., and they had contracts with 20 banks, 100 fintechs. Simon, you want to unpack this a little for us?
Yeah, this made mainstream news around the world, and fundamentally, there are users of fintech wallets that can't pay their mortgage because payments intermediary went under. And the reason I think this is interesting to a European audience is that's actually very unlikely to happen in Europe. So a metaphor I like to give for what happened here is think about a couple of actors. Imagine you have a fintech wallet, and then you have this company called Synapse in the middle, and you have Evolve, who are the bank. So a bank in Europe, obviously Rabobank, they might have Railsr or one of the banking as a service providers in the middle, and a fintech wallet at the end of it. Now, in Europe, the EMI regulations require individual segregation of customer funds held on deposit either at a central bank or at a large clearing bank. Mm-hmm. That is not necessarily a requirement in the US under the MTL, Money Transmitter Licensing regime. You essentially pool customer funds together, and it's the bank's responsibility to figure out what happens to that. But what happened here was the bank didn't necessarily know where all the customer funds were because they were spread across 3, maybe 4 different banks by this intermediary, Synapse. So nobody knows where the money's gone. There are customers that can't pay their bills, and the bankruptcy court is now trying to figure out where the money's gone. So I think there's a lesson for our American friends here in how the EMI license works, but there's also an interesting observation I have for the European audience, which is this is a problem that is a symptom of America's success in banking as a service and fintech wallets in the way that we haven't really seen in Europe, because that market couldn't exist. We capped the money you can make when you swipe a card, the interchange, to, I think, 0.3% under PSD2. In America, what they said is, we're going to cap interchange on debit cards, but only for the big banks. For the very, very small banks, we're not going to cap interchange, called the Durbin Amendment under Dodd-Frank, which was one of the regulations. And what happened since was lots of companies, lots of entrepreneurs like Synapse, who were one of the first, founded in 2014, started partnering with all of these tiny banks. And instead of having 0.3% of revenue every time somebody made a swipe going to the fintech wallet and the bank between them, you now had of that transact. That is a massive amount of revenue and a massive commercial opportunity. So the insight for Europe is interchange isn't a bad thing if you want innovation sometimes. So those are my two thoughts. Couldn't happen in Europe, but maybe we should be thoughtful about, how people can make money.
So any thoughts, because we talked a lot about regulation of this and that are different than what Simon had to say or to add to it?
Yeah, so I mean, I think it's great from what Simon was saying. For me, there is probably three main parts to the story. So one of them is really the customers, who some of them do not have access to their own money for at least 2 weeks, I think, some of them, which is super impact. If you are a business and if you're using some of these accounts for payroll, for example, there is impact into your own employees. So it's not just normal people's money, it's also business money. The second part of it is the regulation, which I think Simon covered in quite detail. And the third part, which Simon was also mentioning briefly, is around innovation. And while this has been such a great innovation, this model of banking as a service, these types of stories really hurt innovation. So having worked at a bank, trying to lead innovation internally, these are the types of stories that will make many people at big traditional institutions thinking twice before they do partnerships. This is the type of conversation that they will bring into a story when you say, let's innovate and let's try to do it. So it's also really damaging for the industry as a whole. And for some of these companies that were doing really great innovation for the consumer, that we might see some of this innovation going down a bit more now.
I think that's such a great point. I told you so. I told you these fintechs were bad. I told you we don't want innovation. Really, you should do everything with a big bang all along. And we should go very, very slowly and very, very thoughtfully and never innovate, really. Because innovation looks a lot like risk, and risk looks a lot like innovation. And we need a way to safely innovate. And we need a way for people to make money in the process. And I think there have been lots of good approaches by regulators to do this. But the large financial institutions still hold a lot of the cards. It's such a good point.
And do you think that they're going to be as averse here because it happened there, or you think really across the playing field these banks are going to be like, we don't want to have this kind of thing happen to us?
You see BCPE and I think Societe Generale through Trezor. Some of the banks have actually tried to do banking as a service and have been quite thoughtful about how they enter it. It's very country specific still.
That's true.
But there are real, I think, attempts to do embedded finance. And then the likes of Stripe and others are coming in and trying to launch their issuing and embedded finance across Europe. I do think it will come, but we'll, like everything, it innovates in the US and then eventually we get it in Europe. And I think that's kind of what frustrates me because I'd say in the mid-2010s, Europe really was the innovator. But at the moment, we have to look to Asia Pacific and we have to look to the Americas to see where innovation's coming from.
For sure. And I think even banks, if they are based in Europe, they are looking at what's happening in the US. So they will, even if they are not based there, I mean, many banks are global as well. So they will be even speaking internally with teams based in the US to understand how are they seeing the markets evolving as well. So US is still a big market and it's one that European institutions are looking at.
So a totally different topic now, but one that we definitely can't avoid, Gen AI. Everybody's talking about it here. And Klarna using it to have staff reduction of about 11%. What are your thoughts on this?
Yeah, I mean, it's interesting. AI is not something new. I have been talking about AI since I was in my consulting days, so before even the bank. It has evolved very significantly now. Many big institutions, financial institutions, have been using AI in the back office for a while now. But now the new solutions, the large language models, they really can bring even more interesting innovation, not just in the back office, but also with consumers' interactions. Some of the banks and some of the fintechs already had chatbots, which, to be honest, some of them weren't as amazing as we wished. And it will be interesting to see where Klarna goes next. It's definitely one topic that I think we're going to see more and more fintech and companies using AI to start really automating some of the existing processes, but also looking into the data and saying, well, based on your historical information, this is also some of the actions or some of the insights that they can give to the customers. And I think that's where the value will be, is let's start looking forward instead of backwards.
Yeah, let's not just do the thing that we used to do with AI a bit better because we have a new tool. What else can we do that's new? And I think it's sort of become fashionable to roll your eyes at AI. Oh, look, another AI thing. You know, a bit like how crypto 2 years ago, all the cool kids were saying like, oh no, yuck. Oh, everything's crypto now. I'm so bored of that. Well, yes, but guess what? There's also something really there in crypto, and there's something really there in AI. And with this one, it's get past the hype. Most executives have tried using ChatGPT poorly and thought, oh, well, this is a terrible product. And it's like, well, you've used it terribly for a terrible use case. That's an entirely separate issue. The fact is, like all technologies, if you productize it really, really well, you can get value from it. But packaging it and producting it and turning it into a product is an art form and a skill. One of the things Klarna has done really well here is actually package it and productize it really, really well. I had an experience recently where I had to move a custom domain from one provider to another with some weird complexities about backlinks in it, DNS settings, host settings, gateway settings, and it wasn't possible through the product. And I had a conversation with a chatbot where I was frankly quite rude with it because I just wanted to get through to a person, and it knew exactly what I wanted to do. It made some jokes at me and figured it out and showed that it was done and dealt with. That was magic. This product, when done well, can be magical. It can be amazing. And so long as I, as an individual, achieve what I want to achieve, I don't really care if I get through to a person. It just historically was the best way to achieve it. So credit to Klarna for doing something that's good. What really sticks in my throat about this, though, is how transparently this is a good news story in advance of going to IPO. Oh, look, we're so innovative, we're using AI. And, oh, look, we're so efficient, we're reducing our headcount. Whereas actually, what used to be efficiencies in headcount now is always an AI story in technology. And there is a real issue there that, like, actually, yeah, you don't need as many people if you are more efficient, and AI can genuinely help you do that. But don't position that as like PR. That's, you know.
Feels bad.
Yeah, it feels weird. Like, that gives me heartburn.
I can understand that. So let's go to something that will give bank executives at Santander plenty of that, and that's their data breach. Again, it was a hack via supply chain. 30 million customers and employees records stolen, 28 million credit card numbers, 6 million account numbers, including balances. So all this being sold on the dark web, how can banks protect themselves?
Big question.
That is a big question. I don't think there's one easy answer.
No, never.
And humans are always the weakest part. But the reality is data is a liability, not an asset. You know, people assumed it was on the asset side of their balance sheet, and people assumed they were safe because of how they've always done things. And actually, what's effective and what's safe are not always the same thing. I don't think anybody is safe from being hacked in the age of cyber warfare. Nobody is safe.
Agreed. Yeah.
And so you have to figure out how you minimize the impact of failure rather than reducing the likelihood of failure. Like, you are going to be breached. The question is, what is the blast radius of that? And so this is where the move towards decentralization as a model becomes actually really powerful and really useful, because the more backups I have, the more redundancy I have, the less I centralize things. Like, fundamentally, the security model has changed. The security model used to be build an ever higher tower so that the barbarians at the gate can't possibly climb over it, and build it higher and higher and higher and higher. What's happened is the higher you build that tower, the higher the reward is if somebody does scale it. Yeah. And now there are very well-funded criminal gangs and state-sponsored actors that want to do exactly that, and it's hugely valuable for them. Now the security model is swinging the other way, which is like, don't put all of your eggs in one basket, move things around, be decentralized, make sure you spread security risk around appropriately.
For sure. And like Simon was saying, I mean, many banks already have big teams trying to really prevent some of these attacks, but I think it's going to happen in the future. One additional thought I have around this is that as well, banks, they hold so much customer data, which is first of all very costly, but also there is a big reputational risk around these types of attacks. So something around the decentralized world is really the digital identity, which if we're moving into that new innovation, and in Europe, for example, they're already thinking about digital identity, there could be something that as well not prevent cyber risks, because I don't think we can prevent them, but really minimize the type and the amount of data that is going to be available everywhere if we have our own digital identity. And there are things that I know you're probably aware of, like zero knowledge proofs, where you don't even have to share your data. So zero knowledge proofs, the way it works is just asks a question, and then in simple terms, it gets a yes or a no answer back. And so it even means that you're not sharing any specific information from the customer. And I think that's where we're going to go in the future, is look into these new technologies and innovations, some from the crypto and the decentralized world, some from the financial services world, and saying how can we protect better, and how can we make sure that we mitigate the risks that we have when these types of attacks happen.
I want to minimize the amount of data I hold. I want to push as much as possible to the edge, to the underlying device. I want to rely on the trusted, secure enclave within that device to store as much as possible. Google Nano is a type of AI that runs just on the edge, just in the device. It never speaks to the cloud. And indeed, I think that security model becomes important, but then you create another threat, because now this becomes the centralized issue the mobile phone does. So I need redundancies and backups to that. And then I need all of that to work without adding too much friction to the consumer experience. So, and then I've got to think about privacy in the process.
There's no one solution.
There isn't, but I do think there are lots of promising approaches. The thing that never gets the headlines is person works hard with a difficult, multivariate, complex set of challenges. But actually, this is a classic example of it. And whilst this was a story about Santander, it will be any bank in the future. It will be any organization in the future. Equifax, Target, Sony, you can name your hack.
Absolutely.
That nobody is immune from this. And I think anybody walking around thinking they are is crazy. But what we do need to change is this idea that if I spend enough money on security, I can fix it. You can't. What you have to do is figure out what you will do when you are inevitably hacked, and minimize risk.
For sure. And one of the key things that we sometimes used to do at the bank was really look into these use cases and say, how can we learn from it? What was the risks? How the attack happened? And then you can learn from it and say, okay, let's put additional controls into it. Every time some of these attacks or the stories happened, one of the key things is learning from it as well. What was use case? How did they take access to data? And in this case, it was through a third-party provider as well. So is there something else that companies can start looking into third-party providers, ask additional questions, or even have some additional controls in it?
The procurement side of large organizations and the access to systems is incredibly locked down. And this is that classic tension between we have a lot of process, but is it effective? And really what you measure and the anecdotes. There's a great quote with Jeff Bezos, which is he really relies on KPIs and data quite heavily. But whenever the anecdotes don't fit the data, he's like, well, the way I'm measuring this is wrong. And I think a lot of organizations keep doing the same old thing and expecting a better result. And it's like, no, it's the definition of insanity. Like, your processes aren't working, and bringing in a bunch of consultants to copy and paste the processes from another bank to your bank and build another big PM project management office so that you can PMO your way into PMOs and have a governance council that governances, and add it to a risk log and da-da-da. That isn't necessarily going to solve the issue. You need to really wrestle with, why are these hacks happening? What are the changes I need to take? Who are the processes? What are the tools I need to put in place? I need operators. And one of the things I've learned spending a few years in startup land is it's not about how much process you can build. It's about the buttons you can push and the stuff you can do. And a lot of large organizations have gotten out of that mentality of actually taking action and doing things.
Okay, so let's move on to another story. Last month, Vodafone announced it wanted to integrate crypto wallets with SIM cards. So what do you think is the most interesting thing about this play?
Yeah, I mean, I love this story, and I'm going to do a shameless plug here on my new book called Web3 in Financial Services, which is just out on Monday. And for me, this story is super interesting because it's telecom really saying, well, we already have security in our SIM cards. So could we use this for crypto wallets? And it also aligns to the digital identity that we're talking about. Mm-hmm. So it's super interesting because you have some banks already looking into this space and trying to look into it and say, okay, what solutions do we want to provide? But at the same time, you have telecom companies saying, well, there is an opportunity here, so maybe we can change our business models and leverage some of the security and some of the hardware that we already have. So it's almost interesting to see that it's really a disruptor. They're really innovative in saying, well, do we wait and see what happens, or do we disrupt ourselves and try and create a new business model? So I think it's a very interesting one to see how it progresses.
So will this give then the telcos an advantage, you think?
For sure, because they already have the hardware and everyone has a cell phone, right? So if they can provide the crypto wallet, which is basically the way that a user access their crypto, it means that they already have a new solution that they're providing. And then from that, they can go whatever they want, to be honest. And they can have digital identity solutions. And then they can even go and partner with banks as well. So they are already position themselves in the front line of these new worlds of crypto, so they can have much more solutions.
People forget how important mobile money is in the global south. They really, really do underestimate it. In our European bubble, we think about our European payment types and oh, yeah, do you remember in the 2010s when telcos tried to launch wallets? Oh, wasn't that cute? And you forget that they had massive success across the subcontinent of Africa and across a lot of Asia Pacific. That is a dominant payment method. So in that world where you have a dominant payment method already established, what can't you do? Well, you really struggle with cross-border. You really struggle with remittances. You really struggle with identity ownership. And actually, having a technology that is natively capable of that with Web3, and having a technology that lends itself to device security, like a SIM card, fit like a hand in glove. It's really rational when you view it from sort of 10,000 feet. My question is going to be execution. What are they actually going to do here? So they've made it available, but the amount of times the telco has announced they've made something available and then actually executed on it 2 years later is, chalk and cheese, miles apart. So will you execute? And number two, if you do, on what use case? Is this for your Vodacom customers in sub-Saharan Africa, in the global south, to receive remittances? If so, how and what partnerships are you going to announce? Again, it's about grounding this in reality and doing something with it beyond the press release. I think that's the fundamental set of questions I have. But I wish them luck because they have the opportunity here to do something really magic.
I was going to ask when, but maybe you don't know
I think
yet.
we don't know yet. But I really like that point that someone was saying, and it reminds me the story of how in Africa they start noticing that people were buying and sending mobile data to their family. And their family used to just hold the data, or they used to sell the data afterwards. And this is now a fully financial solution in which you have mobile data. It's almost like money in Africa. So it does show you, to Simon's point around as well, we might see different solutions depending on if we are in Europe or if you are in emerging markets. But it's interesting to see how telecom, if they do actually go for it and they really implement some of these, they could even rethink some of the solutions that we have nowadays that we haven't even thought about. Mm-hmm. So it's definitely an interesting play. But yeah, let's see what happens.
The Gates Foundation has been pushing this quite hard with a project Loop that they've been trying to work and build cross-border connectivity through Web3 in the African markets for intra-Africa trade. Mm-hmm. But my sense has always been that this is the kind of thing that doesn't really work top-down. You are going to want the populations to adopt something themselves, and if they're going to adopt something themselves, and it's international, it's probably going to be the US dollar. Therefore, if it's going to be US dollar, it's probably going to be a US dollar stable coin, and that's not necessarily going to come from a government of a local country that has no interest in the US dollar subverting their position in the market, even if it's useful or helpful to their population and to their broader economy. So there's a real set of questions, I think, for Vodafone to answer, and a lot of uncertainty ahead. But if you were to say, looking at the crystal ball in 20 years' time, will something like this exist? Yes. Will it be Vodafone? Let's see.
Good answer. Thank you. Moving on to the U.S., a bank called Chime, which has about 22 million users, recently announced to its members that they could get pay earlier up to, I guess, $500 before payday. So do you think we'll see more of these kinds of solutions?
Look, I don't see why not, especially with the amount of data that we have nowadays. And I think this is a big problem, especially, let's say, if you're a freelancer or if you're someone who is almost waiting for your paycheck day. And if there is some data that really shows that you're going to receive the same amount of money each month, why wouldn't you be able to access it earlier? For me, it's a question of why haven't we done this before? There is really a question for me around how they're going to make money, because they are not, Chime is not asking for any fees from this solution. So I do wonder what is their play, what is their wider vision that they haven't told us.
Don't call it lending. Whatever you do, don't call it lending, because there's a thing in America called the Bank Holding Company Act, which says you are either a bank or you're not. And if you're a bank, then you're subject to all of the requirements and regulation of a bank, and you can't really do anything else. So what you see is people contorting themselves to do things that aren't lending really. It's a merchant cash advance if it's coming from somebody like Square, and it's earned wage access if it's coming from Chime, and it's really we're just using data to send money that you would have got anyway a bit early, and we're not charging you for it. And that's the key point, is that they don't charge you for it, but you can tip them. And wait, so you're not charging me for it, but I can tip you. And it's kind of hard to find the button to opt out of that tip, not with Chime,
Really?
but certainly with some competitive products. And it's like, that's where the CFPB, the Consumer Financial Protection Bureau, is coming along and saying, we don't like these dark patterns. We don't like these wallets doing things that look a little bit like banking, because you're either lending or you're not. But the problem is, while I agree with that position, I also think that Glass-Steagall and the Bank Holding Company Act is stupid. Because if you're not going to give out any brand new charters in the US, this is one thing that Europe has done really well, especially the UK, is give out new banking licenses to disruptors. We pull you through the coals, we make it really, really hard, but you can have a banking license. So there's a lesson for our American cousins there, which is figure out how to grant new charters to people, and you might solve some of these issues. Great product. I can see why consumers want it, but my issues with the regulation.
Okay, so for me, I think it's the greater engagement, product usage, and maybe helping with customer acquisition, which is why they wanted to do it. But all really good points. And unfortunately, that was the last story that we could cover because we're running out of time. But it has really been a pleasure having both of you to discuss the fintech news with me. And I would love to do that at another moment, not necessarily at Money2020 again, but hopefully before.
Here. Well said.
Thank you.
Thank you.
Good to be here.
Thanks for listening to Breaking Banks Europe, a Provoca Media podcast in cooperation with FinTech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.